I believe that net zero is a really important guiding concept, but I also know firsthand that the concept of net zero was never really intended for companies themselves. Net
hmm
zero is about how do you get the planet back to some form of equilibrium in terms of radiative forcing. We can't get into a position where the drive towards net zero is just accomplishing paper decarbonization. That is, we're just moving things around on a board and we've become totally ignorant to the whether emissions are actually reducing in the real world.
This is the Future of Finance. Hi, everyone. This is Georges Dyer. Welcome to the Future of Finance. Today, we're tackling one of the biggest questions in sustainable investing, the energy transition. And sometimes, this conversation gets way oversimplified. It's like just divest from fossil fuels, invest in renewable energy, and it's as simple as that. But in reality, it's way more complicated. And my guest today, Charlie Donovan, who is the Senior Economic Advisor at Impax Asset Management, and also a visiting professor of finance at the Tuck School of Business at Dartmouth, really understands that and has some great perspectives on it. He spent his career at the intersection of finance, energy, and climate. He spoke at our annual Higher Ed Climate Leadership Summit last year, and I was so impressed by just how he framed these ideas that I was really eager to have him on the show. So we talk about the whole range of opportunities for investing in climate solutions and the energy transition, how they're many and varied, the importance of supply chains, how Impax thinks about segmenting these markets. We talk a lot about macroeconomic factors and how they have a really important role in driving all of this, and how active investors can really find opportunities in this space and opportunities to manage risk in different economic environments. So you'll see Charlie's a super smart guy. He's doing great work. I hope you enjoy the show and the conversation. And as always, please follow, subscribe, rate, and review. Help us reach more people and amplify the great work that our guests are doing. So with that, enjoy the show. Let's dive in. Charlie, welcome. How you doing?
I'm very well, thank you. So I work as principal economist for Impax Asset Management, which is a $50 billion asset manager across listed equities, fixed income, and private markets. But I came to the firm after having been in academia for several years and was originally at Imperial College London, where I had a research center called the Center for Climate Finance and Investment, an MSc program on climate change management and finance. And part of coming back to the US was a bit of a shift back into the private sector, but it has also led to doing some teaching up at the Tuck School of Business at Dartmouth College, which is about 2 hours up the road
Yeah.
from us here. And it's been great. We actually just got done teaching this course on business and climate change. Huge interest, really motivated, interested students, people trying to figure out how do they get into the space? How do they make a difference with their careers? So hopefully stuff that we can pick up in this conversation.
Yeah, that's great to hear. We've worked with some other folks at Tuck over the years, and we've heard there's a lot of interest from students up there, and that's the case around the country at a lot of these business schools. I think they definitely see the need for the integration of finance and positive impact around some of these big challenges that we face. Nice. And you have kind of a unique role at Impax, right? Maybe just talk a little bit about what you do there.
Well, I'm a financial economist, so my goal is really to try to think about this process of risk integration and opportunity identification. So, Impax has been around for 25 years. There's a lot of frameworks and processes that exist that are part of the DNA of the firm,
hmm
but you can't stop innovating. You can't stop resting on those laurels. So a lot of what I do is working with the investment teams, working with the client teams. We have a sustainability center and try to be a bridge in a lot of ways between what's happening out in the world, what's possible from an investment point of view, and ultimately what do we feel has the highest integrity approach that both maximizes risk-adjusted returns for clients and meets the real concerns about how people's investments are leading to the future that we're all going to live through. And that's not just an altruistic concern. It's also, as we're going to get into, I'm sure in this conversation, climate and sustainability issues, which are clearly economic drivers for change and ultimately they are going to bleed into asset prices. So, my own background of being a finance professor, this was the area of my research. It's been kind of an area of fascination for about 25 years. So, in a lot of ways, it's been a great opportunity to put my money where my mouth is and see how we can move those topics forward within how we invest.
Yeah, and Impax is one of the first, really, right, to sort of take this focused approach and have this thesis around how some of these big changes and energy and issues like water and all these sustainability issues will have real material impacts on investments and to sort of design strategies around that. Is that Fair to say?
I think so. I mean, it really goes back to, I met the CEO, Ian Sim, 20 years ago in London. As you probably know, that 20 years ago, you go to an environmental finance conference, and it was a pretty small group of people. You got to
Yep.
know folks pretty quick who were also interested in these topics. And Impax at that time, a long time back, was working with FTSE Russell on taxonomies to try to describe, how environmental markets or certain areas of thematic investing fed into the greater universe. And over time, that's just evolved into a really disciplined approach about thinking, what are these verticals? What's the value chain? How does one get exposure? What does that mean from a point of risk and return? And then, setting off on the process of constructing portfolios that seek to maximize from these structural drivers towards a more sustainable economy. And that's as we've seen in this last couple of years, this is not a one-way linear bed. It's not just
Hmm.
a train that you get on and expect to chug away at the
Right.
same speed every year. So there's, always the need to kind of understand and update based upon what the data is telling us in terms of what are those drivers? How strong are they being represented in the market at any given time? What does sentiment have to do with this? What is
Hmm.
liquidity? How does inflation and interest rates play into some of that thematic performance? So that's really the core of what I do.
Yeah, that's always struck me about Impax's work is because, our network, the Intentional Endowments Network, in many ways came about as a response to student pressures around fossil fuel divestment. And I think there's sort of often an oversimplified narrative around the energy transition is happening. So divest from fossil fuels and invest in clean energy and your investments will do better. And, I think at a very high level, there's something to be said for that. But as you're saying, there's a ton of nuance in what that means. And, you know, renewable energy companies is a very broad term. There's lots of components and supply chains and dynamics to all of that. And it seems like a lot of people sometimes just point to like a clean tech ETF or whatever and say, oh, this segment of the market is underperforming or overperforming, but it's really not that simple. And I think Impax does a great job of really diving into those details, like you say.
Well, it's a very difficult sector to approach in a passive way, and the reason
Hmm.
is that just as you touched upon, there is a value chain. So if you're just running a strategy that says I'm going to take every name that has a certain GICS sector code and put it into a basket and weight it, say by market capitalization, that's one way to do it. I think the challenge is that there are so many ways in which a nascent market like clean energy is being transformed by, what's the oil price today? What's the state of trade relations between China and the United States? Where are interest rates going? And that's not going to affect all those companies equally. So, a piece of work that we did a couple of years back was to think about how to break clean energy into a upstream, midstream, and downstream, very analogous to how that's done in oil and gas. And as you know, my part of my background is being in the oil and gas industry. So it was a kind of a logical framework. Let's just do the same thing. So you might have, say, wind and solar manufacturers at the upstream. You would have batteries and transmission grids at the midstream, and you'd have things like heat pumps and electric vehicles in the downstream. And those are actually all very different kind of sectors, very different kinds of exposures to some of those macroeconomic conditions that I mentioned. So I'm convinced that this is the right way to think about it, is much more in segments and value chains, in looking at geographic exposures and kind of underlying macroeconomic exposures. Yeah, for me, it's just a kind of a natural way to do it as opposed to just a naive, let's throw everything that's called something in a single basket.
Right, right. And you all work in both public and private markets as well, right?
There is a series of funds, four now funds that the Impax has managed around renewable energy infrastructure, but the bulk of assets today are in public equities, and there's a growing presence in fixed income. And I'm really
Oh,
excited about that because fixed income and bonds and all the instruments that we see in that category are really primary investment. It's actually in the sustainability discussion, bonds and fixed income have been talked about a lot less. And it's kind of ironic because in a lot of ways, when we buy and sell securities, we're buying them in the secondary market. Unless you're investing through the initial public offering, it's not really primary investment. It's taking a view on whether that company continued to perform. But loaning money to a company is, if it doesn't get loaned, that company doesn't exist. And so it's in some ways a lot more of a direct relationship to where these risks are. Also, that has to be renewed. Let's say the average duration of a bond being 5 years. Well, every 5 years, they got to continue to go back to market and and recapitalize. So there's as I said, Impax is leaning into this area with a couple of acquisitions and a buildup of the fixed income presence in the U.S. And for me, it's
Hmm.
exciting because it's a really underdeveloped conversation within sustainable finance, and I think one that we have to move beyond some of the basics around green bonds or impact bonds and really think about what does it mean to hold a core portfolio that is, rather than harming, is actually contributing towards the future that we want to see.
Yeah, that's a great point. And I think, I want to dive into that a little bit around the whole concept of, investing in climate solutions. As I said, a lot of the work in our network was sparked by calls for divestment. Over the years, a lot of those conversations have evolved into the concept of net zero portfolio commitments.
Mm-hmm.
So not just looking at the energy sector, but looking at all the sectors across asset classes in the portfolio and how those assets or those companies are on trajectories to decarbonize. Yeah, just curious your thoughts on that sort of framing, the pros and cons around it. Do you think it's sort of too focused on kind of just measuring the carbon footprint of the portfolio versus thinking about, as you say, like how do we allocate capital to solutions in the real economy?
I believe that net zero is a really important guiding concept, but I also know firsthand that the concept of net zero was never really intended for companies themselves. Net
Hmm.
zero is about how do you get the planet back to some form of equilibrium in terms of radiative forcing, right? It's about temperature increase. It's about all of the physical impacts that relate to temperature increase, and the recognition that the cost benefit analysis of reducing emissions is favorable when you compare it to the consequences of not doing it. So
Hmm.
that's what net zero was meant to do. Mapping that onto companies, however, is a lot more difficult. And there, again, have been some kind of naive approaches that just say, well, all these sectors can do these things. And if you draw straight lines from here to 2050, this is what they should do on a year decarbonization path. And I think the sort of the unintended consequence is that if people follow that path towards investing towards net zero, all they're going to do is end up crowding into particular sectors. So you're going to be overweight tech, you're going to be overweight healthcare, you're going to be overweight financials. And to some degree, that's, maybe that's where some of a more service-based economy, a less emissions intensive economy, that's naturally where it should lead. But we
Hmm.
can't get into a position where the drive towards net zero is just accomplishing paper decarbonization. That is, we're just moving things around on a board, and we've become totally ignorant to the whether emissions are actually reducing in the real world. And because it's
Hmm.
real world carbon emission reductions that ultimately will move the needle. So that's been why Impax has really been much more engaged, let's say, in the policy space, trying to understand and articulate from our own expertise where frameworks need to move, market frameworks need to move in order to encourage the growth of these industries that seem critical, not just from an environmental point of view, but for, national security concerns, for national competitiveness concerns. And I have real worry that net zero has actually, as a concept for companies, has created a false sense of certainty that there is a single pathway, that there's a one size fits all
Right.
approach to doing this. And I think it's a lot more complex, and it depends a lot on the context of where in the world you are, what industry you're in,
Mhm.
and ultimately what's the economic logic for decarbonization in those industries.
Right. Yeah. No, it makes a ton of sense. And I think, yeah, I mean, just as one example, I guess, and is this what you mean? Sort of if an investor was to say not invest in a manufacturing company that's building wind turbines or solar panels because of the emissions profile, the real economy would miss out on that.
And you see a lot of firm asset owners, pension
Hmm.
funds and sovereign wealth funds starting to recognize that they need a
Right.
bucket that's called climate solutions. Because while in a sort of a myopic way, you might say this company's emissions are increasing, the system-wide impact of it growing and becoming a bigger company are net positive. And so I think there's a real active discussion and how people will balance this bucket of climate solutions relative to some low carbon indexing that many people have done. I think this is right where we are. How do you square that circle? And ultimately, I think with time and time again, I come back to you just can't have green finance on a planet that's not greening. And we know, since we know that ultimately the economics of decarbonization driven by technology are favorable. These are just really long-term trends. I think it's better that we line up with those trends than trying to manage to some target that may or may not be achievable given the landscape that firms face. So this is the discussion that's, I think, probably the biggest one in the area of sustainable finance. But, there's some reluctance from some folks to talk about it because there has been a lot of investment in target setting and some of these frameworks. I think Impax has tried to be supportive of the intention without while having our own view on what is the best way as within our fiduciary duty to try to maximize returns for our clients with that intention, but without falling into some traps that can really lead us away from ultimately what is our job.
Yeah, something that might be overly prescriptive or not fit for purpose. And yeah, I agree. And I think it's interesting with all the anti-ESG pushback, and particularly around net zero and climate, and here in the US with some big firms backing out of the net zero asset managers initiative. I think the political stuff is, the whole other conversation in a lot of ways. In some ways, it's kind of forcing a few years down the road here, some of this rethinking. And, I think, like I think you just sort of articulated, I think the whole concept has been really helpful to get asset owners thinking in this long-term framework. And we've seen the similar evolution of like really looking at the carbon footprint of the portfolio and then thinking, well, wait a minute, what about climate solutions? What's the impact on the real economy? So I think it's helped drive some of these conversations and more thoughtfulness over time. And maybe this moment of kind of a little bit of reckoning will be good for everyone to think about what are the positive, useful things to take from those frameworks and what do we need to evolve or move towards in addition.
And I also don't think that we need to, none of what I've said is to move away from the observation that over the long term, for example, investing in fossil fuels has not been a great strategy. I mean, it's a relatively small part of most institutional portfolios. But, I did a piece of work with the International Energy Agency before leaving academia around the long-term investment performance of renewable power stocks versus oil and gas stocks. And this was pre-Ukraine invasion. So we have to kind of give it the caveat that it was a 10-year study, but before that really sizable geopolitical event. And the conclusion was really clear. On an absolute basis and a risk-adjusted basis, renewable power companies had well outperformed fossil fuel companies. So there's a lot of myth making that has gone into this as well, that somehow aligning around these structural changes that are happening in the global economy would somehow be throwing away money. I mean, our thesis is the exact opposite, is that there right. You can see the change ongoing. You can see the growth rates. That doesn't mean that every company that's involved in that sector is going to be a winner, but that's why you hire somebody to, go through and look at the balance sheet and do a cash flow statement and kind of do the bottom-up analysis to figure out where it's headed. But I really reject the idea that somehow that having an awareness of those issues and having a view towards the future and how the economy is changing is somehow putting aside your desire to make sure that, your pension holders or your insurance providers or whoever is achieving the very best return possible. I think it's not always the same because the world moves in all sorts of different ways, as we have seen particularly over the last month. But the ultimate thesis is that we see technology trends that are leading us to some very different outcomes. A lot of this is also entangled with the AI revolution. And right. So we need to just be aware that I think the first starting point is that we're trying to see where there are pockets in the economy that are changing rapidly, changing towards a greater drive towards operational efficiency, greater drive towards the change in materials and processes. And we just see considerable value in backing those kinds of names.
This episode of the Future of Finance podcast is brought to you by the Intentional Endowments Network and our new Endowment Impact Benchmark, which is an exciting new initiative helping endowments and foundations measure their progress on sustainable investing. Participants receive expert feedback, the ability to benchmark against peers, and earn recognition for their leadership. If you're at an endowment or foundation that is ready to advance its sustainable investing strategy, or if you want to benchmark your progress against the field, or if you're looking for a credible way to show your stakeholders that you're taking these issues seriously, learn more and join the 2025 cohort at endowmentimpactbenchmark.org. You mentioned the last month and the new administration here in the U.S. and how much of a factor has a policy like the Inflation Reduction Act, other things that might have been supporting or working to accelerate some of these trends in the transition, been a piece of the process for you all, and what do you see going forward in terms of, you talk a lot about technology and kind of the market forces doing what they'll do. But yeah, in this moment, how are you all thinking about the intersection of policy?
In some ways, it's a tough question because we're just how many days are we into the new administration, and
Right.
it's just a constant flow of information, and in a lot of ways, still trying to work through it. And there are many shoes left to drop. So
Right.
tariffs is a big question. It's far from clear what the end game is on tariffs, immigration, and its potential impacts on inflation and on the labor force. A big open question, the tax policy and how that plays into federal deficits. That's, hasn't even been taken up as of yet by Congress. So in a lot of ways, the concern that we have, I would say, is less about specific measures and policies because, we have to come up one level. We'd never invest on the back of a specific, fund flow from the IRA or any kind of stimulus program. It's actually you got to go up at least a level because everybody knows who's been at this for a while. Administrations change, times change, things are going to happen that you didn't expect. And so to
Hmm.
build a portfolio that's equipped for the long run requires you to be a bit resilient to the exact kind of changes that we're seeing ongoing at the moment. But so I'm more concerned about where we're headed on the macroeconomic front, which I think sets the table for many years of performance within the stock market and in the bond market that conditions, I would say, at least as much as some of the specific policy changes that are being considered with respect to what was implemented during the Biden administration in the U.S.
How much of an impact? I mean, obviously it's hard to say because you don't know what these impacts are going to be, but it's a matter of scale, like given where things are and sort of the momentum behind some of the market drivers for the transition. Do you see in a worst case these macro factors totally halting that transition, slowing it dramatically? What's sort of the level of impact that all this could have on the transition in your view?
Well, what we've already lived through, I hope, the worst of one of the most important drivers, which was a real inflation shock, and then an
Hmm.
accompanying remaking of interest rates in the U.S. and globally. So when you have companies that are investing in solutions that where you spend more upfront in order to gain a lot of savings over time, they are by consequence going to be more sensitive to interest rates. So there are other, we could think about natural gas prices. We could think about, various elements of what goes into when a company wants to do things in order to become more efficient. Forget about decarbonization for a moment. Its ability to put in new capital expenditure plans is going to be conditioned by interest rates, and the payoff from energy efficiency is going to be conditioned by how much they can save on oil, natural gas, coal, whatever that substitute is. So that's the kind of fundamental relationship. And in that way, I believe that we've lived through the worst, a severe price shock around fossil fuels, a fairly substantial interest rate shock as the Fed and other central banks moved out of the COVID periods. I'm very hopeful that we're back into not dealing with these big shocks and starting to equalize in which companies can make plans on what they believe to be a fairly more stable set of macroeconomic conditions.
Let's hope so. What about, we're talking a little about the transition, and at the same time, we're really starting to see, more viscerally the physical impacts of climate
Mm-hmm.
change. And, obviously the fires in Los Angeles being the most recent big news story here in the US. But, globally, it seems like a week can't go by where there's aren't major floods, fires, disasters that are impacting this. And I would think in some ways kind of driving what some have called climate inflation as well as
Mm-hmm.
these impacts can drive up prices. And I guess what are your reflections on that as we move into more and more impacts and I guess maybe on a more like specific level, some of the assets or companies that you're investing in that have infrastructure or real assets, how do you think about the physical risk from climate change for those? And is that a big consideration?
Well, there's no doubt that insurance is the canary in the coal mine on
Hmm.
climate because insurance is the leading indicator of what kind of loss is expected. And somebody's got, in order to insure that loss from you, has got to reclaim a reasonable premium. So we have really been actively monitoring what's been going on in the insurance market and using that to think about how close we are to a potential tipping point in which even though many of the impacts of climate change lay off into the future, it's really this question of when do people begin to realize that this has real effects? And so to just give it another example, the US utilities, electric utilities, have been, unfortunately, some of the worst players on being essentially tipping physical climate risks into reality. Because as we know, climate is what I would call a risk amplifier. Very rarely could you say this thing happened just because of climate change.
Right.
It interacts with how we manage resources, what kind of disaster response we've got in place, how fragile infrastructure is at that specific location. And so when we went into a process of thinking about, well, how well prepared are U.S. electric utilities? My colleague Julie Gordy went into a series of consultations. And to make a long story short, the amazing realization was the US utilities that are best prepared today for physical climate risks are those that have already been through some form of crisis, those that have already been culpable in, say, a wildfire because of a substation catching fire or sparks from lines. So it's a good story in the sense that people will change and companies will change and they will begin to have best of class policies. The slight bad news there is that it took them going through a crisis in order to recognize that this was material to the bottom line and existential to them as a company to get the right processes in place. So in a lot of ways, that engagement is now to try to diffuse that knowledge that here's your colleagues that understand what's at risk and here's what they're doing. And essentially, you're opening up a lot of financial risk for investors by not having that same level of dedication to the problem. So I don't, we've moved so far forward with our understanding of physical climate risks, and I'm sure you're aware there's a whole spate of startups out there that are using AI and huge data sets and doing really fantastic stuff. So it's really not the knowledge, it's the embedding of that knowledge into management plans and systems, and that's where we just have to make clear that this is an urgent task, and it's a financial risk for these firms that we're trying to guard against as much as anything.
Yeah. Yeah, it's a great point, and it is kind of sad in a way, as you say, that it took experiencing the impacts often to take action. And, I think it's just, as an aside, I think a lot of people sometimes a critique or criticism of ESG investing or just sort of looking at these factors in the investment process is that it doesn't necessarily have a lot of impact. My feeling has always been if you've got diligent investment analysts asking management of companies about these risks and how they're thinking about them, that, hopefully it gets it on their agenda and on their radar to help minimize it.
I mean, done well, ESG is just a simple tool in the tool chest. It's a risk management tool. You can do that. You can do that as a checkbox exercise. You can do it as a much more kind of thorough. It really depends upon one's view of which of those risks are material, to what degree, and how they're going to play out in particular sectors over time. So I think at Impax, we've always tried to just say it's a tool. We use this tool. We think it provides some insight, but it is, there are a number of other things that any investor is considering, and the relative emphasis that one might place on that insight relative to the others that get done in the investment decision-making process changes. So a lot of this is just horribly overblown and just needs to recalibrate towards, we're all here doing our jobs to try to, do the best that we can for our clients, and also looking towards a future in which we have different views about how the future is going to play out. And that's how this works. That's how markets work. We all take a view, and 5, 10, 15, 20 years from now, we can all look back and figure out who was right. And we just can believe that we have a really strong, compelling view that things are going to change, and then they're going to change in a certain way. And those companies that are positioned to navigate those changes are going to be better off.
Yeah. Yeah. Nice. And as an academic and an economist, one of my sort of favorite topics around all of this is around the mechanisms around climate to sort of internalize those externalized costs. And just curious your views on that in terms of, from a policy perspective, what do you think are the most effective ways to do that? Is it pricing carbon? And if so, carbon taxes, cap and trade? What's your sort of take on, if we had a sensible policy, what it might look like?
Well, I was always a big fan of the experiment that Canada put in place, which is, you charge for the source, you charge waste. Nobody thinks that you should, pick up trash for free. And so why should we have a situation in which we pollute for free? It just doesn't make any sense. It's a common resource. We all as taxpayers are going to pay at the end for the damages. It just is economic logic that the producer of that waste should pay at the front end. So I don't think that there's, when I talk to my colleagues who have been in economics a lot longer than I have, they think that climate's a really simple problem. And I always say, is that right? Tell me why. They're like, well, it's an economic externality, and you just tax or price the externality correctly, and this thing takes care of itself. So we know the world is not as easy as economic models.
Right.
And so then it gets into what's the best way to do this. And a lot of the thinking in the Inflation Reduction Act clearly was we were having such trouble getting the right price on pollution that if you just subsidize the technologies and the projects that go about cleaning up pollution, that kind of is an equivalent effect. And we're seeing the limitation now of that logic, which is that it requires the government to spend more money. So I hope that we're going to come back to this debate, because what it really is for me is just about fairness. It's just not fair for taxpayers to pick up the bill for the higher rates of profitability that get earned by folks who don't pay to have their waste picked up. And if we could just kind of drive home that central message, I hope we'll get a lot further, because we still don't have a consensus about the need for it. And we can get into a lot of, very particular debates and policy oriented people who've got, the next best way to do this. But I think we're still stuck on the need. And the need for me is just simply one of fairness and economic efficiency. And once we get that landed, then we can get on to what's the right way to make a program work.
Yeah, I love that. And it kind of leads nicely into my last couple of questions here. The first of which is, along those lines, what is your vision for the future of finance if it were to be working better, more fair, and having the outcomes we all need?
The first part is just what we talked about. You have to have everybody pay their own fair share, and in a lot of ways, it's a very libertarian argument. It's not it's just plain and simple that you take care of your house, I'll take care of mine, and by doing that, we'll have a nice front yard together. So that's the big part of it. It's about driving individual responsibility to the firms and to the owners of specific assets, and having them pay their fair share. It's that simple. The next one is about how the capital markets will adapt. And clearly what we're seeing now is the failure of a theory of change that somehow the tail could wag the dog. I mean, capital markets are nameless, faceless, global in their nature. There is just, we don't have as a world, we don't have international governance mechanisms that, even if you did want to somehow drive change through the capital markets, that could effectively be enforced. And so we have to go back to the crucial role of how firms respond to consumer demand signals, because they're always responsive to consumers and the role that they play. And they're responsible to the market environment that's set through regulations. In every market in the world, and even the most free markets in the world, some of them have the most rules, because without rules, it's anarchy. It's not a market. It's something that none of us would want to live through. So I'm just concerned that the future of finance returns to the idea that with a well-functioning market requires clear and logical rules, and then within that parameter, people go off and do the best thing that they can. But finance is really a tool for capital allocation. But the demand signals for where that capital should flow to its highest and best use really come from the real economy. That comes from consumers. It comes from governments as they set the rules of the road. And I hope that the future of finance returns to that kind of basic premise as a way for us all to proceed.
I couldn't agree more. Yeah, it's that concept of kind of free creativity within constraints, but you need those constraints, those rules of the game, to be aligned with reality and science and the outcomes we're looking for. So we started our conversation talking a little bit about your role at Tuck, and you've been in academia in other ways in the past. And we're hoping to, reach a lot of students and people interested in this, young people interested in this space through these conversations. So what advice would you give, or do you give, to your students that are interested in kind of charting careers in these areas?
Well, my first piece of advice is you got to be patient. You got to be patient, because I know that there are, either at the undergraduate level, the graduate level, very smart, motivated individuals who want to make an impact now. And that's entirely possible. But you have to, if you want to do that for a big company, then you're going to have to probably be patient. So if your idea of making an impact is starting a company, getting out there and doing it on a very local level, and then scaling it to the next slice of bread, go for it. But there's a trade-off, which is that the resources that you need to assemble, the capital that you need to bring in, sometimes that's hard to do without the credibility of having come through the ranks, let's put it. And maybe that's less of an issue today than it was for you and me as we kind of came up through our careers. There's a lot more direct route from idea to world beating business. But I think there's a trade-off there that I kind of encourage people to think about, and it's a risk return calculation on their own part. Are they
Hmm.
willing to go through a couple of failed startups in order to make happen exactly what they see? Or do they want to kind of proceed through the channels of bigger companies or banks or whatever they choose to do in order to gain the experience to make that journey more credible to the degree that they want to lash out on their own. So we're clearly in a moment in which, 2 years ago, it was open season. My students were getting jobs I could have never dreamed of getting at their age, and I got to tell you a little bit, I was getting jealous that this was seemed to be becoming so lucrative. But here we are in a very different place, and a lot of people that we're hiring have let people go, and
Hmm.
it seems like everything is a little bit kind of thinner in this space, but the pendulum will swing. The pendulum
Hmm.
will swing. And it's time now to really just think about, as an individual level, how do you want to position yourself when the floodgates open back up again? Is that within a bigger company? Is that starting something now and keeping your head down and bootstrapping it until the faucet comes back on in terms of funding flows? There's a lot of kind of tactical choices, but I think it's really starts with, as an individual, I ask, the folks that ask me for that kind of advice, what's your own risk tolerance, and
Hmm.
how willing are you right now to fail several times and fail constructively in order to be ready the next? Or do you want to bide your time doing the work that might not be 100% aligned to your objectives, but puts you in a different place in terms of skills and experience to do that down the road?
Yeah, it's great points, and definitely a lot to be said for experience either way on either of those types of tracks. And I guess if you do kind of go in the bigger company where maybe you're not having the impact, I think it's a great point about the impatience. I definitely felt that starting my career, but looking back, there's lots of ways to have impact even within your job if it's not in the core job description, but also outside of your job while you gain that experience and can maybe have more bigger impact down the road.
Well, and there's also just the basic to be clear on what's coming. And even if your job has nothing to do with climate, sustainability, the stuff that you want, being clear to others about what it is that's coming down the road, how important it is that we address these from, a human point of view, from an environment point of view, but ultimately from that we all continue to thrive and flourish in an economic perspective. Just that's an important thing, to turn the corner in which this is no longer something that you only talk about with people that sort of you think get it, because
Hmm.
everybody can get it. And there is actually a way to present the argument around moving to a more sustainable economy that I think has really broad appeal. It's just we got to think about the language you use, got to think about the tone, got to think about the proof points, and ultimately this is a non-political issue if we get that right.
Yeah, could not agree more. Well, Charlie, thank you so much for the time. Always great to catch up and talk with you. And thanks so much for all the great work you're doing.
My pleasure. Appreciate the invitation.
You bet. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.